There's this specific moment I have watched happen in a dozen times across my career, especially when going through a due diligence just before a major grant decision is made. So, usually, as it's known, a checklist is brought to guide the process. So, you find that we bring the audited accounts, so we are looking at the audit opinion, that's clean. Then we are looking at program expense ratios. Then we are looking at what is the percent, how are they sitting. We are looking at the operating reserve, what's the balance sheet saying. We are looking at the current ratio, and then sometimes you find that all boxes are checked. And based on that, of course, plus other internal control matters that the checklist gets to tick, a recommendation for approval is done. Not usually at that point, but you're given feedback that your due diligence went well. But then, usually, 6 months into that grant implementation, you find that the reporting has come, especially for restricted grants that have very timed, like 6 months reporting. So, when the reporting timeline arrives, what happens is that the first reporting deadline is missed. The financial reporting deadline, for that matter, is missed. So the narrative is there, but it's kind of not agreeing with the financial report that is eventually brought out. And when you look at everything, the grant is technically in compliance because no hard deadline at that point has been violated. It was just a report that gives them the first insight of how implementation are doing. So, at this time, nothing is actually noted as visibly wrong. But looking at it, what happened between the due diligence and that first missed deadline is actually not a mystery. The signals were there in the financials before the grant was made. There were sections of the financial statements that the standard due diligence checklist did not ask anyone to look at. And they were hiding in plain sight because the framework that was being used to read these documents probably was not designed to bring them to the surface. And that's what I want to talk about today. What grantee financial statements actually contain, because I have been sitting on that side where the most useful information lives and what a grant portfolio's perspective trains you to look for that a standard audit review process does not. So before we go into the documents themselves, it's worth establishing at this point that we are trying to assess, when we read the grantee's financials, from a grant portfolio perspective, not from the author's perspective. The question is not simply whether the organization is financially healthy in a general sense. The question is whether this organization has the financial infrastructure to deliver on a specific set of program commitments over the period of this grant, while again simultaneously managing whatever else it's on its balance sheet. Those are different questions. So an organization can be financially healthy by standard metrics and simultaneously be operating a finance function that will struggle under the specific demands of a complex multi-year award like that, like the one we are talking about. But then on the flip side, an organization can have a very thin balance sheet and a finance function that is genuinely excellent, organized, and also well led. The financial statements contains information that speaks to both of these dimensions if you know what you're actually reading. So what I'm sharing today comes from 2 decades of sitting inside non-profits finance functions, building and repairing these systems and generating these documents. I have seen the documents look like what I'm talking about, and I have seen when the underlying system is sound. And the difference about those two, where it's sound and where it's not, it's usually something very subtle, but they are there. So let's look at the balance sheet. So the balance sheet, also called the statement of financial position in non-profit accounting for that matter, is the first document to read when you are evaluating a grantee's financial health. And it's the document that contains the most information about the organization's resilience. Most people read it primarily for the reserve number, but there are four other things it tells you that matter more than the reserve position, especially for the portfolio management decision. So the first is the composition of the net assets. You see, net assets in a not-for-profit organizations, they come in three categories. We have the net assets without donor restrictions. We have the net assets with donor restrictions. And in some instances, we have permanently restricted net assets. Let's look at now like things like the endowment funds. So the total assets with donor restrictions and in your financials tells you almost nothing useful without knowing how those assets are split. For example, if you look at the total asset number on the summary page, you will see that, okay, this organization has this total net assets, but this one does not tell you anything substantial without knowing how these net assets are split. So an organization, for example, with $5 million in total net assets, 4 million of which are permanently restricted in, for example, an endowment funds, and 1 million of which are donor restricted in capital projects. You see, this organization has essentially no unrestricted financial flexibility. On the other hand, an organization with the same $5 million in unrestricted net assets has enormous flexibility. This split, it really matters more than the total figure you see at the summary page. The second is the relationship between current assets and current liabilities, what we call the current ratio. Basically, this is the measure that the organization can meet its current short-term obligations. So it's a standard metric that we have to look at, and it's always worth looking at. But what matters more than this ratio itself is the composition of the current assets. You want to look at cash and short-term investments. Because these are they genuinely liquid? Accounts receivables, for example, from government grants. Let's say if the organization is receiving large government grants, or a large foundation may be sitting there, but it may not be collectible on a timeline that matches the current liabilities that they are being captured against. Again, an organization with a healthy current ratio is built primarily on receivables from, like, an organization that has a healthy current ratio built on receivables from single government contract is at a risk of non-renewal, because significantly, this kind of grants are very fragile. And so this kind of organization is actually also operating on a very fragile ratio. The third is the trend in operating surplus or deficit. You see, a single year balance sheet shows a snapshot. What you want to see is whether the net assets without donor restrictions have been growing. They've been growing, they've been stable, or they've been eroding over the past 5 years. An organization with a solid reserve position that has been declining by 2 to 5% annually is structurally different. It's in a different situation from one with the same reserve position that has been stable or growing. So this trend in itself is a signal. When you look at the surplus or deficit from not a single year balance sheet, but a 3-year period balance sheet, you're able to pick a signal, because This snapshot alone is a measurement. Then the fourth, and this is the one that actually rarely appears on the standard due diligence checklist, is the relationship between deferred revenue and program commitments that it presents. So we know deferred revenue in our nonprofit balance sheet is typically it represents funds that have been front-loaded, funds that have been received, but the qualifying activities have not been incurred. So an organization with large deferred revenue balance relative to its operating capacity, it already signals that it has future program delivery commitments that are already funded and is seated on its balance sheet. So whether the organization can actually deliver on those commitments is the required time frame of that grant, of the funds that have already received within the required conditions, is a capacity question that the balance sheet opens but cannot answer on its own. So probably something to keep an eye on. And then swiftly moving to the income statement section. So the statement of activities, which in the non-profit equivalent of an income statement, tells you about the revenue structure. Very important. And the revenue structure is one of the most revealing indicators of organizational stability in a grantee relationship. Why do I say that? The first thing to look at is the revenue concentration. If a single funder represents more than 25 to 30% of total revenue for the organization in a particular year, then the organization definitely has a concentration risk. If a single government contract represents more than 40%, the risk is even more acute in this case because government funding is subject to legislative or sometimes circles that are outside the organization's control. From a portfolio management perspective, funding a highly concentrated grantee creates an interdependency. For example, if their major funder exits or reduces, then the capacity of the organization to deliver on your grant is affected by a decision you had no part in making. The second is the relationship between restricted and unrestricted revenue over time, not just in a particular time period, but over time. So you find that organizations that are growing their unrestricted revenue base through individual giving, fee for service, or even general operating support from multiple sources are building financial resilience. On the other hand, organizations where revenue is predominantly restricted and predominantly from a smaller number of institutional funders, you find that they are financially fragile even when the total revenue is substantial. Because the restriction matters because restricted funds cannot be used to cover operating infrastructure that makes the delivery of programs possible. An organization that, for example, is 100% restricted is in a meaningful sense, it's asking its funders to kind of collectively provide not just program funding, but also the organizational capacity to manage that funding. And very few grant agreements are designed with that understanding explicitly. The third is the pattern of in-kind revenue. So in-kind revenue is sometimes not given attention, but it's important to check whether it's being used to manage the functional expense ratio. In-kind contributions are legitimate and valuable, and it varies from organization to organization on what they consider as in-kind. The threshold for each organization varies. So they are also one of the easier mechanisms by which an organization can shift its functional expense ratio without changing any actual cash flows. So when in-kind revenue is large or relative to the total revenue, and the program expense ratio is usually high, it is worth understanding the valuation and allocation methodology for the in-kind contribution before drawing conclusions from that kind of a ratio. Then let's look at some of the areas that are rarely given attention, and that is the notes. The notes to the financial statements are the most unread section of an nonprofit's audited financials because they contain a lot of information that matters for a grantee capacity assessment. For example, the functional expense allocation note describes the methodology the organization used to split shared costs across programs, management, and fundraising functions. A note that says the organization allocated expenses on a basis of time and effort estimates in square footage, reviewed and approved annually by management and the board, describes a methodological sound process with appropriate oversight. Then there's also a note that says expenses were allocated based on management estimates. It provides essentially no information about the methodology and no basis for evaluating whether the resulting allocations are reasonable. So it's worth paying attention to that note. The difference between these two notes is significant and it correlates reliably with the overall quality of the organization's financial management. So I would highly recommend that you don't ignore that note next time. Then the other one is the liquidity note. This one discloses how the organization manages its liquidity and what financial resources are available to meet general expenditure within 12 months of the balance sheet date. This note often contains information about lines of credit, board-designated reserves, and the availability of donor-restricted funds for operational purposes that is not visible anywhere else in the financial statements. So organizations that have thought carefully about liquidity management tend to write detailed, specific liquidity notes. And then organizations that have not gone that far just give the generic disclosures that will not tell you much. So the significant accounting policies note is where revenue recognition, grant accounting, and functional allocation methodologies are described. An organization that recognizes grant revenue when the conditions of the award are substantially met, rather than when the cash is received, is applying the more technical correct treatment. And then an organization that only recognizes a grant revenue on receipt, regardless of the conditions, may be accelerating revenue recognition in ways that actually overstate the financial strength in any given year. And thankfully, we have the GAP, the IFRS for SMEs, and now the impasse that has outlined very detailed guidance on revenue recognition standards. The other one is the related party transactions. If disclosed, it tells you about the governance environment. For example, transactions between organizations and board members, executives, or entities they control are not inherently problematic, but they do require proper disclosure and appropriate oversight. Organizations where related party transactions are common, large, and described with minimal detail, those ones warrant governance scrutiny. So when you read a grantee's financial statement with a portfolio lens, you're building a picture from multiple dimensions simultaneously. The balance sheet tells you about resilience and flexibility. The income statement tells you about revenue structure and concentration risk. The functional expense statement tells you about how the organization categorizes and manages its cost. The notes tell you about accounting policies, methodologies, choices, and the quality of financial governance. No single indicator is conclusive. A thin reserve position, for example, combined with excellent revenue diversification, a sophisticated allocation methodology, and a strong liquidity disclosure might represent a young organization that is well managed and growing. A robust reserve position combined with high revenue concentration, a vague allocation methodology, and a generic note disclosure may represent a mature organization whose financial management has kept pace with its growth. What you are looking for is pattern consistency. The quality of the allocation notes should be consistent with the quality of the audit opinion and the sophistication of the liquidity disclosures. When a financial package is internally inconsistent, when some parts of it suggest strong financial management and other parts suggest significant gaps, then that inconsistency in itself is a signal worth investigating before grant decision is made. The conversation you have with a grantee's finance team during due diligence is also a data point. How they describe their financial management processes, how quickly they can answer specific questions about the allocation methodology or their grant tracking systems, how they respond when you ask about a specific line item variance tells you something that no financial statement can tell you directly. The quality of that conversation is a proxy for the quality of the financial management systems underneath that organization. So reading grantee financial statements with a portfolio perspective is a skill. It is built through practice and through knowing which questions to bring to the documents. The standard due diligence checklist that we know gives the program officers a starting point, but it was not designed in many cases to assess the specific questions that matters for most grant outcomes, whether this organization has the financial infrastructure to do what it's promising to do. In the next video this week, we go into the specific leading indicators, the financial signals that appear before problem surfaces in program delivery. These are the metrics and patterns that allow a grant portfolio director to intervene early and constructively rather than managing a crisis that were predictable 6 months earlier. If this raises questions about grantees in your current portfolio or about your organization's own financial statements, you can leave a comment. The most useful future content in this series will come from the specific challenges that you're actually navigating and sharing. Thank you for watching today, and this is the Farm Framework.